Highly volatile exchange rates make real economic activity and financial transactions difficult, and it also impacts investments in foreign assets and hedging strategies needed to offset the foreign currency exposure. Central banks manage exchange rates, at least to some degree. We call the policy framework of a central bank the exchange rate regime. We'll first talk about the ideal currency regime, then we'll discuss some actual currency regimes.
The ideal currency regime has three properties. The exchange rate between any two currencies is credibly fixed. All currencies are fully convertible. They can be exchanged at any time and any amount. And each country can have independent monetary policy to achieve domestic objectives like growth and inflation targets. Unfortunately, those three properties are not consistent. If you satisfy the first two conditions, then really there is only one world currency, so each country could not have its own monetary policy. So there can be no ideal currency regime. It's not possible. Independent monetary policy is important to countries. They want to manage inflation and unemployment. But if there was perfect capital mobility and credibly fixed exchange rates, investment capital flows between countries would counteract monetary policy. Expansionary monetary policy, which lowers interest rates, would lead to foreign capital outflows. Foreign investors would look elsewhere to get higher returns. This would force central banks to sell foreign currency and buy domestic currency to maintain the fixed exchange rate. This reduction in the domestic currency supply would push up interest rates, so the country would end up where it started. The expansionary monetary policy would fail. Floating interest rates make independent monetary policy possible. A decrease in the domestic interest rate from loose monetary policy would make the domestic currency less attractive. This will depreciate the domestic currency relative to other currencies. With the domestic currency being cheaper, exports will go up and imports will go down. This reinforces the goal of expansion for the domestic economy. Now that we've covered the ideal currency regime, let's take a historical look at currency regimes. Currency regimes have evolved over time, and at any given point in time, multiple systems can coexist. But for a given time period, there is usually one dominant system in the world. Prior to World War I, the US dollar and the UK pound were on the classical gold standard. The price of each currency was fixed in terms of gold. That linked all the currencies together because they all referenced gold. The classical gold standard operated on what's called the price-specie flow mechanism. A country with a trade surplus would accumulate gold. This would expand the domestic money supply, making prices rise and reducing exports. This would help keep the balance of trade from getting too far off. The classical gold standard limited how much money could be printed. It was based on the gold reserve in that country. This inspired confidence in the value of the money. But sometimes countries would discover new gold. This could impact the trade flows. This tied monetary policy to trade flows. A country had to expand its gold reserves before it could expand the money supply. Some argued this kept inflation in check. The gold standard was abandoned in the 1930s when world trade dropped by over 50%. In 1944, many countries adopted the Bretton Woods system. This was named after the town where it was negotiated. Maynard Keynes from the UK and Dexter White from the US played key roles in its development. It was a system of fixed exchange rates with periodic realignments. This system lasted until the early 1970s. In 1973, the Smithsonian Agreements took over. The chronic inflation in the 1970s made the fixed exchange rates with periodic realignments unsustainable. Speculators would take profits right before the realignments took place. Effectively, the market was determining the exchange rate.